So bank memorandums information about all your includes all the reduction and deduction from your bank. And memorandum will include all additions and increases to your bank. For example, you have bank account, you earn the interest. So interest earned increase in your bank account. Notes receivable, the money that you're supposed to get, will be again increasing your bank account. So bank reconciliation is a useful procedure for control. It may happen that at any single day there may be discrepancy between the balance in your bank account and balance in your accounting books. Balance in accounting books, I of course mean the cash balances. So you need to decide the true balance, what is correct, the bank account balance or your balance in the accounting books, what is correct. Maybe the maybe both adjustments will do the adjustment to make I deliberate and the pay make of effects will transfer band books. So there is so reconciliation using bank information and then reconciliation using book information. So what we can so all deposits in transit. So we made deposit to the bank. Bank did not record. So therefore, where should I just what side in the books or there in their balance? Of course, in their balance. So them add this deposit in transit. So outstanding checks issued, and once they are issued, they are recorded by the company, but bank has not paid them yet. So but with them eventually. So therefore, you must deduct outstanding checks balance per bank. Bank memoranda. Any unrecorded memoranda should be listed as debit or credit. So bank charges, they're already made by the bank, but you have not recorded them. So therefore, they will be deducted from balance books. And interest that you already earned and the bank recorded the interest, but you did not record it yet. So therefore, you will add this interest per books. Then there may be errors, either by you or by the bank, and so there must be all errors by deposit are reconciling items in balance per book, and all errors made by the bank are reconciling the balance per bank. So the main principle, so you need to put the adjusting somewhere. You put it to where it is not at the moment. So if the value is currently not in the state, they will adjust the balance. And if the value of the book but is in the state, then you adjust your books. So the first step is the balance on the bank statement. So what will be included here? So you will add, so for the bank, deposit is hidden but not recorded. Therefore, add interest to the opening balance per bank statement. Secondly, the checks were already issued and recorded by the company, recorded in the book, but the bank recorded has not recorded them yet. So therefore, you must subtract outstanding from balance per, and then various errors, but these are the errors made by the, and then you will adjust the balance